Hi everyone, this is Professor Gallagher. In this video, we're going to talk about some of the topics that are included in Chapter 2 of our course. We're going to start by taking a look at the expanded tax formula. And this is the tax formula that we will be using for the rest of this course. So our tax formula is going to start off with our gross income. We will subtract any permitted deductions from gross income to get our adjusted gross income, which adjusted gross income will become a very important number as we go throughout this course. From adjusted gross income, we'll subtract either the standard deduction or itemized deductions, which we'll talk about in a later chapter, to get our taxable income. To figure out our tax liability, we're going to multiply our tax rates by our taxable income, and that is calculated for you in either the tax tables or the tax rate schedules if the taxpayer earns over $100,000. From our tax liability, we'll subtract any tax credits that the taxpayer qualifies for, add in any additional taxes like self-employment tax or the healthcare related tax, and subtract any tax payments or refundable credits that the taxpayer is eligible for. And that'll give us our total tax refund or the tax that's due with their tax return. So again, our tax return is going to be our basic Form 1040 along with the schedules for 1040. There are 6 new schedules for the Form 1040 this year, which do take place of the full 1040 from prior years. There is a line-by-line locator that gives you a description of the item and the line and the tax form that item is found on, and that is on page 2-7 of your textbook. I do recommend that, especially when we get to our tax projects, that you reference that page. Adjusted gross income, as I said in the prior slide, is going to be a very important number. This is our gross income minus a list of permitted deductions that taxpayers can qualify for. Many of our deductions and credits are going to be based on that AGI number, and certain benefits are going to be reduced or eliminated when AGI exceeds certain levels. When taxpayers are filing their tax return, there's 5 different filing statuses that those taxpayers can qualify for. If an individual is single, meaning that they're not married as of the last day of the tax year, then they would file as a single taxpayer. For the married filing jointly tax filing status, the couple must be legally married on the last day of the tax year. The marital status of the couple is going to be determined under the laws of the state in which they reside, and it does not matter if only one individual out of the couple has earned income. So in this case, if a couple gets married at 11:59 p.m. on New Year's Eve, then they would be considered married for that whole tax year. The married filing separately filing status can be used if a couple is married but they elect to file separately. The standard deduction can only be taken if both make the same selection. So in this case, if a couple is filing separately, they either both have to take the standard deduction or they both have to itemize their deductions. The tax return must show the Social Security number of the other spouse, and in most cases, it is not advantageous for a couple to file married filing separately. There are certain deductions that they do not qualify for. The head of household filing status is for individuals that are unmarried at the end of the year. This could be a married taxpayer that's living apart from a spouse during the last 6 months of the year. They could qualify. They must be a U.S. resident or citizen, and they must maintain a household for a qualifying person, a dependent, for more than half the year. There is an exception to this that a taxpayer could qualify for head of household if they are providing support for their parents that live in a separate household. There is also a filing status for qualifying widower with a dependent child. So this status is permitted only for 2 years, and the taxpayer must have been eligible to file a joint return with their spouse in the year that their spouse passed away. They must be unmarried, and they must pay for more than half the cost of a household that's the principal place of residence for the taxpayer and a child for the entire year. In this case, temporary absences are permitted, so if the child was at summer camp or hospitalized for a month, then that would not count against the residence requirements. So let's take a look at an example. If we have a taxpayer whose spouse passed away on December 1st, 2017, and he has no qualifying children, which status would the taxpayer select when filing his 2018 return? So to go back to 2017, since the taxpayer was married when his spouse passed away, the taxpayer would file as married, filing jointly for 2017. For 2018, the choices would be to either file as single or qualifying widower, depending on whether the taxpayer has qualifying children. In this case, the taxpayer has no qualifying children, so he would need to file as single for 2018. So next, for certain tax filing statuses, like our head of household, we need to determine if a taxpayer has dependents. So these are related individuals that are living with the taxpayer, and they may provide financial support for these individuals. So they would qualify as dependents if they meet certain tests. The existence of dependents is going to be important for determination of child credits, filing status like head of household, and other tax matters. The dependents for a taxpayer are going to be reported in the middle of the first page of the 1040 form. To be considered a dependent, the dependent must be either a qualifying child or a relative and first meet 3 general tests. The general tests are that the dependent taxpayer test, that the dependent cannot be claimed as a dependent for someone else. The joint return test is that the person being claimed as a dependent cannot file a joint return with his or her spouse unless that return is filed only to claim a refund and there is no tax liability due on that return. The third general test is the citizenship or resident test. The dependent must meet one of the following requirements. They must be a U.S. citizen, resident, or national, be a resident of Canada or Mexico, or be an adopted child of the taxpayer if the child is a member of the taxpayer's household all year and the taxpayer is a U.S. citizen or national. So once those 3 general tests are met, we're going to first see if a dependent would qualify as a qualifying child. A qualifying child must meet 5 additional specific tests: the relationship test, the age test, the residency test, the support test, and then there is also a special test if the child could be a qualifying child for more than one taxpayer. So let's start with the relationship test. The child must be the taxpayer's child or descendant of a child, so grandchild, and a child that is being adopted or whose adoption is pending would qualify. A stepchild, an eligible foster child, a brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendants of those individuals. Next is the age test. At the end of the tax year, the child must be one of the following and be younger than the person that is claiming the dependency. The dependent must be under the age of 19 or under the age of 24 if they are full-time students, or the dependent could be totally and permanently disabled regardless of their age. So next we have the residency test. A qualifying child must live with the taxpayer for more than half the year. Again, in this test, the temporary absences due to illness or education are not going to be considered as time away from the home. And Finally, we have the support test. To be a qualifying child, the individual must not be self-supporting. They cannot provide more than one half of his or her own support. So support is broadly defined by the IRS. It typically includes food, shelter, clothing, medical care, and education. It does not include life insurance premiums, but it can include other things like daycare expenses, etc. In the case of a full-time student, scholarships are not considered to be included in support. There are some situations where a child could be the qualifying child of more than one taxpayer. So in this case, the IRS has set forth some tiebreaker rules to determine which person has the priority in claiming that dependency. In addition to that, Form 8332 can be used by an individual that it is allowed to claim the child to release the exemption for that child. So in this case, if the people that are eligible to claim the child, if one of those people are the parent, then the person would be able to claim that child as a dependent. If both people are the children's parents and the child lives longer with one parent, then it would be the parent with the longer residence. If both people are the parents and the child lives with each of them the same exact time, then the parent with the higher adjusted gross income would claim that child as a dependent. If none of the people that could claim the child are the parent, then again, it would go to the person with the higher AGI. So let's take a look at an example. We have Mimi. She's 22 years old, and she's a full-time student at Ocean County Community College. She lives with her parents who provide all of her support. During the summer, she put her web skills to work and earned $5,000. Can Mimi's parents claim her as a dependent on their joint tax return? And we are assuming that all 5 tests under the qualifying child are met. So the answer in that question would be yes, they would be able to claim her because she has met all of the requirements. So the next way that we can have a dependent is a qualifying relative. In this case, they must also meet 4 specific tests. The first one is not a qualifying child. So they cannot be considered a qualifying child to be a qualifying relative. Next, we have the relationship or member of household test, the gross income test, and the support test. So the person that is being claimed as a dependent must be a member of the taxpayer's household for the entire year or be related to the taxpayer in one of the following ways: a child or descendant of child, a stepchild, an eligible foster child, a brother, sister, half-brother, half-sister, or descendant, a stepbrother or stepsister, a mother or father, or brother or sister of parents, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law. So there are a lot of relationships that can qualify for that test. The gross income test, the dependent must not have gross income equal to or greater than $4,150. For the support test, the taxpayer must provide more than 50% of the qualifying relative's support. Only the amounts that are actually expended are considered for the support test, and scholarships are not considered. There are 2 exemptions to the support test: the multiple support agreements that we talked about in the tie-breaking rules, and also children of divorced parents. So to take a look at a quick example, to be a qualifying relative, which of the following individuals would have to live in the home of the taxpayer for the entire year? If we go back and look at that long list of relatives that qualify for the relationship or member of household test, we will see that cousin is not listed. So the cousin would have to live in the home of the taxpayer for the entire year to qualify.